Welcome to our deep dive on pet insurance payouts and why veterinary credits can reduce future claims. First, we will outline the core idea. Insurers reimburse based on your net out-of-pocket cost, not the original billed total. Next, we will walk through how credits, discounts, or corrected overcharges can retroactively change what you actually spent, triggering an insurer audit and a deduction on a future payout. Finally, we will share practical steps to avoid surprises and to document your real expenses clearly. Let's begin. Here is our roadmap. First, we will clarify what insurers consider your real net cost. Then, we will explain how credits and discounts can trigger audits and clawbacks. After that, we will review simple numbers to make the process very concrete. Next, we will provide actionable steps you can use before you submit a claim. Then, we will test your understanding with quick quizzes. Furthermore, we will cover edge cases and an important disclaimer. Finally, we will summarize the key takeaways and conclude. To start, let's define net cost. Insurers base reimbursement on what you actually pay out of pocket, which is the final net cost after any discounts, credits, or corrected charges. If your clinic later issues a credit for a past visit, that credit reduces the cost of that earlier service, not the new one. Consequently, insurers view any difference between what they previously paid and the new net cost as an overpayment. This distinction between gross charges and net paid amounts is central to understanding why clawbacks happen. Now, let's see how insurers calculate payouts step by step. Here is the typical payout flow. First, the clinic issues a bill. Second, any discounts or credits are applied. This defines your final net amount. Third, you submit a claim. Fourth, the insurer checks whether your deductible is met. If it is not, remaining deductible is subtracted from the net amount. Fifth, co-insurance is applied to the remainder to arrive at the payout. Next, if a later credit is discovered, the insurer recalculates the earlier claim using the new net amount. If this recalculation shows they paid more than they should have, the difference is an overpayment. Finally, rather than invoicing you, most insurers deduct that overpayment from your next eligible claim payout. Now that the logic is clear, let's visualize timing with a second diagram. This sequence diagram shows the timing. The pet owner pays the initial bill to the vet clinic. The insurer reimburses based on the available net amount and documentation at that time. Later, the vet clinic issues a credit, which effectively reduces the cost of the earlier visit. During a subsequent claim, the insurer receives updated records that include the credit. The insurer then recalculates the older claim and determines there was an overpayment. Finally, the insurer deducts that overpayment from the next eligible claim payout. This timeline clarifies why the deduction appears later and is tied to the updated information surfaced during a new claim. Next, let's connect this to the BRCO, Audit Shock. Now we address the so-called Audit Shock. When an insurer learns about a credit applied to a past visit, they recognize that they reimbursed too much previously. Importantly, the insurer is not correcting the clinic's billing. They are correcting their own liability. Therefore, they classify the difference as an overpayment and deduct it from your next eligible claim. Although this can feel like an unexpected clawback, the purpose is to ensure the insurer never reimburses more than your actual net out-of-pocket spend. Moving on. Let's compare gross versus net with a side-by-side view. On the left, the gross bill is the original total before any discounts or credits and may include errors or overcharges. This amount is not the basis for reimbursement. On the right, the net paid is the final amount after all credits and discounts and represents your true financial loss. Insurers use this net number to apply the deductible and co-insurance percentages. This contrast explains why later credits lead to recalculations and possible deductions. Now, let's ground this with concrete numbers and a table. Consider this example. The initial Visit A bill is $400. The policy has 80% co-insurance, and the deductible has already been met. The insurer initially pays $320, which is 80% of $400. Later, the clinic issues a $100 credit attributed to Visit A. The true net cost of Visit A is therefore $300, and the insurer should have paid $240. That means there was an $80 overpayment. On your next claim, suppose the calculated payout is $350. The insurer deducts the $80 overpayment and pays you $270. This is how credits create deductions on future payouts. Next, let's cover what you can do to minimize surprises. Here are practical steps. First, gather final invoices that show all credits and discounts before you submit a claim. Second, confirm whether your deductible is met and understand your co-insurance percentage. Third, include itemized receipts for services and take-home medications or eligible supplies. Fourth, attach proof of payment such as card receipts, patient portal screenshots, or statements. Fifth, if a credit appears after you have already been reimbursed, send the updated invoice to the insurer proactively. Sixth, track all communications with your clinic and insurer to create a clear audit trail. Finally, if you discover missed eligible costs, submit them quickly to help offset any deduction. Next, we will reinforce these with a markdown checklist of what receipts typically work best. Use this checklist as a quick filter. Include an itemized invoice that shows services, dates, and quantities. Make sure the final amount after credits or discounts is clearly visible. Provide proof of payment that includes the method, the date, and at least the last 4 digits of the card. Ensure take-home medications and any eligible supplies are listed separately. Avoid handwritten adjustments that lack clinic letterhead or verification. And avoid screenshots that do not show totals or payment details. Next, let's test your understanding with a short quiz. Quiz time. The question is, if your clinic applies a $100 credit for an overcharge on visit A, but uses it during visit B's checkout, which visit's net cost changes for insurance? Option A, visit A. Option B, visit B. Option C, both visits equally. Option D, neither visit. You may pause the video now to think about the answer. We'll discuss the answer in the next section of the video. The correct answer is visit A. Even though the credit is applied at visit B's checkout, it corrects the cost of visit A. Insurers connect the credit to the original service date and adjust reimbursement accordingly to ensure they do not pay more than your true out-of-pocket expense for visit A. Next, let's do one more quick scenario. Here is the second question. Your policy reimburses 80% after the deductible, and your deductible is already met. The original bill was $400, and the insurer paid $320. Later, a $50 credit is issued for that visit. What overpayment will be deducted from your next eligible claim? Option A, $10. Option B, $40. Option C, $50. Option D, $80. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is $40. The corrected net is $350. 80% of $350 is $280. The insurer previously paid $320, so the difference is $40, which will be deducted from your next eligible payout. Now, let's briefly cover edge cases and a disclaimer. Before we conclude, let's address edge cases and a disclaimer. Policies and claims practices can vary by insurer, plan type, and jurisdiction. For example, multi-pet policies might handle credits per pet. Prescription dispensing fees may be treated differently than services, wellness or preventative add-ons might be ineligible, and out-of-network or third-party financing can complicate proof of payment timing. Therefore, always request written clarification from your insurer regarding how credits, discounts, and corrected charges are applied. This video is educational and not legal or financial advice. Next, we will provide a mind map to reinforce the documentation strategy. This mind map centers on claim documentation. The main branches include final invoices that already reflect credits and discounts, proof of payment such as card receipts, statements, or portal screenshots, itemization that separates services, medications, and supplies, policy context that notes deductible status and co-insurance percentage, and a communication trail comprising emails, clinic notes, and insurer messages. Keeping these elements organized streamlines claims and strengthens your position if a deduction is applied later. Now, let's capture the most important takeaways. These are the core points to remember. Insurers reimburse your net out-of-pocket expense, not the gross bill. Credits reduce the cost of the original visit, even when applied during a later checkout. Overpayments are typically deducted from your next eligible claim rather than billed to you. To protect your payout, submit final, discounted invoices with complete proof of payment. Finally, Track and submit any missed eligible items promptly to help offset deductions. Next, we will summarize the whole topic in brief. In summary, reimbursement hinges on your final net spend, not the initial gross bill. Later credits change the mathematics of past claims, which can lead to a deduction from a future payout. Proactive, thorough documentation reduces surprises and speeds resolution. For unusual scenarios, request written clarification from your insurer to avoid misunderstandings. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If you found this helpful, please like the video, share it with another pet parent, and subscribe for more tips on navigating pet insurance and vet bills. We would love to hear your questions and experiences in the comments. Tell us how credits and claim deductions have affected you and what you want to learn next.